Inflation is running even hotter than expected, rising at the fastest pace in 4 decades. So how aggressive will the Fed be in taming inflation, and what does that mean for markets and your portfolio? We have a power wealth planning and investment management panel to break it down. Joining us is David Nelson, Chief Strategist and Co-Chief Investment Officer at Belpointe Asset Management, and Michael Lee, founder of Makori Strategy. David and Michael, thank you for joining us.
Thanks for having us, Michelle.
How are you doing, Michelle?
All right, David, welcome to Kitco. So let's start with you. The U.S. Consumer Price Index rose 7.5% in January year over year. Now, that is putting a lot of pressure on the Fed to act more aggressively to try and tame this inflation. So, David, how hawkish do you think the Fed is going to be here?
You're already starting to see it. In the middle of the day, markets were actually trying to, crawl into the green. And St. Louis Fed President James Bullard came out and said he expects rates to go to 1%, 100 basis points, the Fed funds rate by July.
Okay.
That's a different dynamic. That certainly wasn't priced into the market. And the market's headed south. And right now, what you're seeing in Fed futures right now, you're seeing it priced into about 200 basis points by the end of the year.
200 basis points by the end of the year is a 50 basis point hike pretty much a given for March, David?
Yeah, it is. Coming into today, it was only about a 31% probability. And now we're looking at, it jumped over 50% probability. And I think it's all the way up to 67. I think in another couple of days, it'll be almost 100% certain. I won't be surprised if the Fed actually comes out intermeeting and does it in advance.
All right, Mike, what's your read here?
Yeah, if we get a 50 basis point hike intrameeting, that would be, nothing like that has happened since the 90s. That would really take everyone by shock. But I don't necessarily know that would rock equity markets. I think a lot of things are going on here. I think inflation is going to slow down this year. Okay, for a few different reasons. First is you're going to have higher base effects. Second, you're going to have demand destruction. Third, you have the Fed coming into play, although I don't know what raising rates is going to actually do for inflation other than home prices. It's not going to affect rents. It's not going to reduce a gallon of milk. It's not going to make oil prices go down. You're so far away from taking real liquidity out of the economy vis-a-vis the Fed funds rates. I definitely think we're going to get 50 basis points in March. How much after that, I think remains to be seen. And I think while that's a huge unknown, it's going to be hard for markets of any kind to make meaningful direction.
All right, but Mike, it sounds to me like you're not that concerned about inflation. So does this mean you think we've reached peak inflation with this number here?
I certainly hope so. If we're not at peak inflation now, we will be in the next couple of months. Like I said, mostly because of the demand destruction and lower base effects. And so what I would say, if inflation continues to accelerate, okay, you now are running into a real societal problem. Governments in countries like Argentina have been toppled because of this. But I have to believe at some point these supply chains will be much better than where they are right now. And maybe a big reason for a lot of the price increases over the last month was Omicron. You would think with the slowdown that we had in the economy, the noticeable slowdown we had in December because of COVID popping up, that inflation would have slowed down. Maybe there was an additional negative effect on the supply chains because of that. But the month over month growth, even though it was slightly below expectations, at this point, you should be seeing that simmer down. If we have an equal or greater number in when February comes out with the January numbers, or in March before the meeting, I like David said, I could see the Fed popping in right there and getting active right away.
All right, but David, do you buy this supply chain issue, that this is really what's behind here? I mean, let's face it, Powell has been very wrong with his call that inflation is transitory. You can't be surprised that we have such a high rate of inflation after we've had unprecedented fiscal and monetary stimulus. I mean, this can't shock anyone when you pump all this money into the system and now you have rates, inflation going so high. So do you think that this is ultimately really linked to Omicron and global supply chain issues?
It's certainly part of it, but you're speaking to the elephant in the room. There's just a massive liquidity in the system that's been, started more than 12 years ago. And that's continued unabated. You add the fiscal stimulus that's coming from Washington and the likely fiscal stimulus that's coming. They're going to probably take the bill that couldn't get through and parcel it up. Some parts of it are going to get through. I think Mike speaks to a good point. The supply chain issues, they'll have to get better. And it's certainly part of the problem. But to me, the heart of it, one of the areas you got to look at, you have to look at the prices of energy. Energy touches every line item of the income statement. And it's not just at the corporate level, it's at everybody's pocketbook. Whether you're driving to the station, whether you're driving into the city, I don't care how it affects you, one way or another, you're paying for it. And those prices right now, it's not just about the price of oil, it's about the lack of supply and the fact that our commodity complex and our energy complex pulled back so drastically. A lot of CEOs are very content to just pump at a modest rate. And that because they want to reward their shareholders. And it means a lot of cash flow to the shareholders right now.
All right, but we can't look at this without taking into account the big political picture here, because that's part of the reason we have this situation. And although the Fed is supposed to be apolitical, can't dismiss the political content. It's a pick your poison environment for the Biden administration and the Fed, because we've got high inflation hurting Democrats. We've got midterms coming up. But what could hurt them even more is a new recession. As you both know very well, Fed Chair Paul Volcker managed to rein in double-digit inflation in the 1980s, but at the cost of double-digit unemployment. And that, of course, really pummeled President Reagan's popularity. So we know the Biden administration is definitely not considering spending cuts or tax increases that would act as fiscal anti-stimulus. So it's all on the Fed here. David, with midterms coming up in the political environment that we're in, with a lot more political pressure being put on the Fed from the left, does the Fed really have the stomach to do what's necessary here?
Well, they've blinked in the past. And I would say the first hint of economic contraction, you'll likely see a pause. Maybe they'll start hiking every meeting, and then all of a sudden there'll be a pause. Already, the most ominous sign in the market right now is not the fact that the 10-year is now above 2%. The most ominous sign is the spread between 10 and 2-year paper is contracting dramatically and hinting of an inverted yield curve sometime this year. That speaks to recession. The economy is slowing down. The question isn't whether we're slowing, it's what are we slowing to? Are we slowing to 3%? That would be great. But if we're slowing to, sub 2%, 1%, who's going to be the first economist that comes out and says it's zero?
Well, let's talk about that R word, Mike, recession, because as David points out, the yield curve, obviously a good leading indicator for recessions. In the past, a flat or a negative yield curve typically been followed by a recession 6 months later, and the yield curve's been steadily flattening since March of last year. So what do you see here? Are you concerned about a recession, Mike, or do you think that a soft landing can somehow be engineered?
So, my concerns over recession are close to zero in the next couple of years. Recessions are caused by debt bubbles, right? We don't have your classical debt bubble a la the financial crisis, a lot of over-levered tech companies in the dot-com boom that didn't really have any revenue or profits. Credit spreads have not blown out. High yield spreads have not blown out. And if you look at the Chicago Fed National Liquidity Index, you really haven't seen meaningful tightening of financial conditions yet. Okay, all this could change in 6 months from now, 3 months from now, a year from now. But on the radar, I'm not looking at an inflation. I'm sorry, I'm not looking for a recession. I'm not fearful of a recession. What I still firmly believe we are mid-cycle, and what you are seeing right now is a Fed that probably should have started tapering QE a year ago or longer to give itself a lot more optionality in situations like this. Really just caught offsides either from hubris, from thinking that supply chains were going to come back online, things were going to be things were going to fix themselves, or total political means with Jay Powell trying to get reelected. It doesn't really matter at this point. All that matters is that they're offsides. But I would say since November, the 2-year has already moved over 100 basis points higher. And so they're already pricing in 4 rate hikes. How many more are we going to get in there before we get an inversion? Okay. What the yield curve flattening is saying is this is a policy error, that the Fed is just too late to start slowing down inflation. So I'm definitely watching the 2s, 10s, 2s, 30s every day.
Okay, but overall, Mike, you sound rather optimistic to me. You're not worried about inflation getting too hot or too out of control, and you're not really worried that we're going to have a recession either. Am I reading you correctly?
Yes. I would say until the market can get their arms around what the glide path for the Fed is going to be, I think we're in a bit of no man's land, bouncing around, a lot of volatility. I think this inflation is bad. I think if it doesn't come down dramatically over the next 6 months, you could be looking at more than just the House and the Senate flipping to Republicans. Like this, there definitely is a probability that inflation accelerates, not decelerates. So if that sort of thing does happen, then yes, a recession and possibly worse is on the horizon.
Okay, but you're not really seeing that as a top concern. David, do you concur? Do you think that somehow there can be this environment that's engineered where we do have this coveted soft landing?
Well, I think you got to separate two things. You got to separate Main Street from Wall Street.
Right.
Main Street could probably be okay here. Wall Street's got another problem because when rates rise, multiples contract. That's something we've been seeing, for the last 6 months. And you've seen long duration equity kind of take it on the chin. And a lot, I think this year investors want food on their plate. They don't want just sales growth. They want to see food on their plate in the form of earnings, cash flow, and or dividends. And that's why you've seen this kind of fairly large rotation into value this year. I think that's going to swing back and forth depending on the headlines. But overall, I would think for the next year or so, until multiples contract to a meaningful level, or to a sustained level, which is lower than where we are right now, then I think that dynamic plays out until then.
All right. So, David, how are you positioning your portfolio to play this environment?
Well, I'm absent the usual suspects. No real estate, zero. No utilities, zero. Overweight energy, financials, and also healthcare as well. I think healthcare often gets misplaced because there's a lot of fear from the Biden administration that there would be drug price controls. That to a large degree has not happened. This is a growth at the right price sector. So if you're looking for growth at a reasonable price, that's it. Unfortunately, so many other areas of the market morph from growth at the right price to growth at any price. And I think the markets are doing a reset right now.
So what would be your top 3 investment ideas for this market environment as you read it now, David?
I think you have to have the energy in picture. There's a reason why energy is the best performing sector this year, the best performing sector last year. Even if oil prices stay where they are right now, the cash flow is there. Look at the numbers. The average energy company out there is probably trading with a single digit PE, a free cash flow range 7 to 9%, and a 3% dividend. In a market that is trading at over 20 times, that's probably a good place to hide. Financials can do well, but they need more than rates just going higher. The fact that the yield curve is starting to invert, that's problematic. Also, they're being attacked by fintech as well. Jamie Dimon said it. He said that fintech is their biggest concern over the next couple of years. So energy right now, materials, and you're just going to have to do your homework. Even in tech, you can find companies trading at respectable multiples and reasonable growth rates. You don't have to buy into a company that has zero earnings or zero GAAP earnings as far as the eye can see.
All right. And Mike, what are you thinking? What are your top investment ideas for this market environment?
Yeah, so biggest position is in energy, as David said. And if you think about the energy as a sector, all the wind is at its sails. You still have an economy that's coming back online. And if you go back to the summer of 2020, the story with this economy is it's coming back. The growth and the resurgence of the economy has just been better than anyone imagined. And as a result, the demand for oil is increasing as well. We simply don't have the supply to meet that demand. Combine that with a hostility towards fossil fuels and a green everything and a build back better, that puts a premium on the asset. And as David mentioned, so I play that through the XLE. That's my largest holding. If you just pick the two biggest stocks in the sector, as David mentioned, ExxonMobil and Chevron, both 4% plus dividends, very low multiple, and the wind at its sails. And if you ask yourself, okay, this, in my mind, equity markets are very uncertain for the next 3 to 6 months. Okay, maybe that time frame, maybe we get a little bit more clarity from Powell as to where they're going, and then we kind of resume our bull run. But until then, what's the easiest place to make money? What about that energy thesis is going to change? These energy companies aren't going to get expensive overnight. The price of oil is most likely to head over 100 than below 80. So unless there's something that some exogenous event that causes a recession that we don't know about yet, I can't imagine demand slowing. I can't imagine a lot of more supply coming online, and then you have reasonable valuations, high dividends. So that's an easy play. Then I own consumer staples and I own financials. Those are my big overweights at the moment. I own tech, but am underweight in my portfolio.
All right, well, we can't talk about oil and ignore a major geopolitical development that may or may not unfold, and that is, of course, a Russian incursion into Ukraine. We have tensions on the border there. We're not quite sure how the Biden administration is going to react if there is any kind of movement from Putin into the Ukraine. Even sanctions, if there is no military option, which is unlikely, but even sanctions would have an impact here. So what happens in that event to the energy sector, David?
Most geopolitical events, not all, but most geopolitical events that cause a disruption in the market are usually buying opportunities. And I think this one will be one as well. It's a serious issue, obviously, both from a military standpoint, from a geopolitical standpoint, and a foreign policy as well. I'm not quite sure how the Biden administration is going to handle it. I don't give it high marks so far. The bigger issue on the geopolitical stage and the elephant in the room is Taiwan. That's something that would rattle the markets and it wouldn't recover from it. If Taiwan went down tomorrow, all right, we would not have the manufacturing capacity to produce the goods we need. We don't have the semiconductor manufacturing capacity. It's why we're working so hard to get it here. It's actually a national security imperative to do that, but that's going to take years. So how we balance that out, how we deal with China and keep them from moving in, that's on my radar.
Well, and of course, China is looking very closely at how the Biden administration responds to the aggressive posturing by Putin, because if the Biden administration signals weakness in the way it handles Russia, then that would certainly embolden China to take a more aggressive stance regarding Taiwan. But before we would see any kind of Chinese action, what do you think that would mean for the energy sector? Obviously, we would expect a big pop there if there is continued instability and more aggressiveness coming from Putin with regards to Ukraine there, David. Wouldn't you expect oil to shoot up initially, at least?
Yeah, it would. And if somebody didn't step in the supply, put in the supply, as Mike was talking about earlier, my guess is, given what the administration's done in the past, there'd be a major shift again back to OPEC. Not a very friendly part of the world, and echoes of the 70s. So I hope that doesn't come to pass. But obviously, all options are on the table.
So, David, what then do you see as the biggest market risk at the moment?
It's really all of the above. And, I think Mike would agree. I think at some point, it depends on how these things unfold over the next 3 to 6 months. Right now, equity markets are challenged. And I think investors have positioned accordingly. You saw a tremendous, output from the bond market today. For the average investor out there, what's the offsetting risk asset class? The 64-40 portfolio. What do you do with the 40?
Yeah.
We know what to do with the 60, but what do we do with the 40? Because that's in a bear market or heading into a bear market. That's the challenge we have in front of us.
All right. So, Mike, what do you do with that 40% that traditionally would go into bonds then?
So, you need to be looking at floating rate securities and shorting your duration. That's the way you can play into it. I like preferreds. I'd be looking to buy them now, but these are beta securities. So there's a lot of volatility in there. But if you're short on that duration side, Duration is not your time of maturity for those that are not up to date on the bond lingo. It's your interest rate risk. So you want to take as much interest rate risk out of your equation. So you shorten the duration, and I would typically in the floating rate, those aren't the highest quality, but those are bonds that are resetting on a quarterly basis, so you can play the raise and rates there. Then most of them are linked to short-term indicators, and then even though you're losing money in cash, having cash at a point right now wouldn't be the worst thing, because we're definitely going to have some dips this year. We're going to entering a new volatility regime, and it's all Fed driven. I think some of these geopolitical risks. I think at first people were a little bit nervous, but there doesn't seem to be the will to go to war in America, especially over a country that means almost nothing to us. So I think avoiding military conflict in Ukraine is very, very high on it's a high probability. It's high on everyone's list. So you're struggling right now. So if you own the long bond since December, you're down dramatically. So just from the end of the year, just this year, and when does that bleeding stop? Because the long bond, the 30-year Treasury, is typically one of your best hedges against volatility in the world and volatility in the market. So you're in this rare kind of scenario where stocks and bonds are selling off, and you're left with very little other than your sort of cash alternatives. But if inflation persists, those cash alternatives are going to be worth, if you're getting 2% on your short-term fixed income, you've only lost 5% in a 7% inflation world. That's not really a desirable investment. So this is going to be a tough year for a lot of people. I would just say to most investors, just stick with it. I think we're going to come out the other side just fine.
All right. Well, I have to ask you about gold, because Kitco viewers are certainly not surprised by inflation. We've had several guests and analysts calling for it for well over a year, just looking again at the unprecedented fiscal and monetary stimulus. Yet, David, gold is not really budging. It has not really fulfilled its role as an inflation hedge. Why not? What's happening here?
One word: Bitcoin. I think Bitcoin kind of changed the dynamic for gold. I'm long gold. But it hasn't performed in some key moments, over the last number of years. And I think the rise of Bitcoin, kind of speaks to that. I think whether or not Bitcoin is a valid asset class or not, I think that train has actually left the station. It doesn't matter what we think, people are in it, and it's worth what the next person is willing to pay for it. And it's extremely volatile, and obviously should only be a small part of people's portfolios right now. But the fact that some of the commodity agencies are looking to regulate it, that tells me they believe it's going to be here for some time. The fact that it's decentralized is going to make it very difficult for governments, including China, to completely eliminate it. They'll fight it, but unless they act in concert, which doesn't seem likely, I think Bitcoin's here to stay.
And you really think that Bitcoin is the big reason that we're not seeing gold perform as we would expect it to?
I think so. Right now, it's the only one I can come up with. The best correlation for gold is an inverse correlation with the dollar, and that hasn't even panned out. From time to time it works.
So what would you say? Do you have an outlook on gold for the end of the year, David?
I don't have a price target. I don't think I'm going to get hurt in gold right now. It'll be interesting to see if there's a sell-off in Bitcoin if gold follows. But right now I own it, and it'll probably be, if I get stopped out of it, then so be it.
Yeah, well, so far we have not been seeing any correlation or any significant correlation with gold prices going up in the environment of having a bit of a Bitcoin sell-off as we've had over the first couple of months of the year. Mike, what's your read on gold? Do you have an outlook for us?
Some gold as an inflation hedge just seems to be broken. Okay, the best explanations I've been able to come up with and I've heard is that it's so much easier to participate in other financial assets to hedge against inflation. Okay, whether it's real estate, whether it's stocks, or whether it's crypto, it's a lot easier to use those as your inflation hedge. So if you were long a lot of real estate going into the spring of 2020, you're in very good shape right now. If you were long a lot of stocks, you're in excellent shape right now. If you were long a lot of Bitcoin, you're in excellent shape right now. The only thing that really hasn't come along with it is gold. And so in the summer of 2020, I think gold was at 1900. I am, in my mind, it's going to 4,000 a la 2010. 2011 when it went to 2000, right? So I was expecting a doubling event at that point, and it just hasn't happened. So something is broken with gold at the moment. I would still say, you need to own some physical gold in your home because you have no idea what's going to happen. I would recommend gold coins as a way, if inflation does get out of control and it becomes very difficult to buy loaves of bread, and there is civil war, not that I think that's going to happen, but think about it. What are you going to pay people with? You're going to whip out your cell phone, and you're going to Venmo people worthless money. Having some physical gold in your home, in my mind, is something that everybody should do. And it could be a small amount or a large amount. If it's a large amount, to a large degree, that's been dead money for a long time. But I own physical gold. I'll continue to own physical gold until it becomes my kids after I die.
All right. Well, hopefully that is a very, very, very long time away in the future. Thank you so much, Michael. Appreciate it. Michael Lee, founder of Makori Strategy, and David Nelson. Great to have you with us. David Nelson, Chief Strategist and Co-Chief Investment Officer at Belpointe Asset Management. Thank you to you both.
Thanks, Michelle.
Thank you.
And thank you for watching. I'm Michelle Makori, coming to you from New York. Keep it right here on Kitco.